Hello, my name is Linda Keith. I am the Chief Credit Trainer at lendersonlinetraining.com, where we do help lenders, analysts, underwriters, and anybody else who needs to lend to somebody say yes to good loans when they are looking at tax returns and financial statements. I am joined by David Stauffacher, our Senior Credit Trainer. Hey, David.
Hi, Linda. How are you?
I'm
Great,
good, but I
thank
have hair in my face, so let me take care of that. Today's question is one that maybe the viewers are thinking, do I even need to watch this one? Everybody knows what to do with depreciation. Fact is, not everybody does. They don't all understand why. And then there's that whole section 179 thing that can mess things up. And what about the stuff on M1? So there is more than meets the eye for many of you. So we're going to stay tuned on this. David, I know people learn to add back depreciation, but at a basic level, I'm not sure they know why. And when you don't know why you're doing things, then you can't apply it to other things that are similar. So let's just start out with what is depreciation and what is like it, and what do we need to know?
All right, thanks, Linda. Yeah, let's talk about depreciation basically in its definition focus. It's a bookkeeping entry, right? We're writing off a tangible asset, so something that we are able to see, feel, machinery, equipment, etc. So we're writing that off. So it's a bookkeeping function. So what do you mean write off? Well, this goes back to GAAP, generally accepted accounting principles. So we're matching an expense to the income that is earned during that period. So it's the matching, and also it's calculated based on the useful life of the item that you're depreciating, whether it's a large piece of equipment, whether it's real estate. They have different useful lives, but we're trying to match that. And it does help, especially I'm a financial statement guy. It does help to actually make the financial statement show more realistic that some of these items do wear and tear over time. The most important part I think I draw attention is it's non-cash, right? It's unrelated to actually how we paid it. We may have financed it with cash. We may have financed it with loan payments. We financed this item maybe a year ago, 5 years ago, 10 years ago. And why am I still depreciating it right now? Because I paid for it a long period of time. So that's what we're trying to do with the matching items, that what we paid of cash or finance is still the value of the item has depreciated over time. It's been reduced in value over time. Okay, that's depreciation. Another item that many of our listeners are common with is amortization. Now we're dealing with another bookkeeping entry, but now it's intangible. It's like intellectual property, goodwill, those items that we can't necessarily see, but it still has value that we're actually going to reduce over time. And Uncle Sam's allows us to do that. Another non-cash item. Lastly, here's one that I've seen just on very few occasions. Depletion. Now, it depends on certain parts of the country. I'm in the Midwest, up in Wisconsin. It's a bookkeeping of natural resources. So some items, you get into the lumber industry as well, timber, coal, there you get to write off the depletion of natural resources. So what do they all have in common? They're basically non-cash. We're expensing something, but we're not writing a check. We wrote that check a long time ago. So in Lenders Online Training, what we do is we take all these three together and we kind of combine them all in the same spot. So many of us use a software platform that's going to be able to pick this item, put it in its formula to be able to do those. So the issue is, where do we find them and what can we use as we add them back as non-cash? Now we know kind of why it is that Uncle Sam allows us that opportunity to do that. So Linda, on the tax return, taxes are different than GAAP, right?
Yes. Yes, they are. Taxes are different than GAAP, and I think it's helpful to understand both because sometimes we do get GAAP financial statements. Sometimes we get tax returns. And in fact, we have a live stream on comparing tax returns and financial statements for the same period and why aren't they the same, right? Should you worry about fraud? Well, depreciation is one of those things that could be different between them. So in a financial statement, generally accepted accounting principles, as you said, depreciation is a matching concept. And I crack up when I think about the useful life for a building is 25 years. What are we thinking at the end of 25 years? The building will scope and be gone. And in fact, this is also a huge reason we can't use business financial statements directly is because if you come into me and you have a building that is depreciated over time, what's its fair market value, right? What could we lend on? So these business balance sheets are not cash, but they're also not fair market value. They're historical cost. So you do need to understand the difference there. Now in tax returns, though, the depreciation is how quick can I write this down to defer taxes? It has nothing to do with matching. It's really just, I'd rather pay taxes later than sooner. So for example, Section 179, that first year depreciation write-off is significant and often is very helpful in paying less taxes. And you can have something that on a tax basis financial statement is completely depreciated. That's because it's 1 year old and they took first year depreciation. So you can't even draw conclusions by comparing the asset dollar amount to the accumulated depreciation against it when they're using tax basis depreciation in a way that you could do it perhaps with GAAP financial statements. Both of them, if we're analyzing financial statements or tax returns, we add it back. EBITDA, earnings before interest, taxes, depreciation, amortization, is we've added back depreciation, amortization. I notice it's not EBITDA, which would add depletion. I guess we just don't expect it that often, so we just go with EBITDA. So variations, there are variations that require a different approach. And in our training, we recognize this and we work with the people to understand it. Some of your financial institutions do not start with the bottom line taxable income of the 1120, 1120S, 1065, and instead start with Schedule M, net income per books. Well, if you do that, then everything else in Schedule M1 needs to adjust. So you got depreciation on the front page. You got depreciation in the books, not in the return. You got depreciation in the return, not in the books. So you actually have to do a little bit of a dance to get the depreciation figure right. But then what's your software going to do with it, David? It's going to add it back.
Add it back.
Right? So dance all you want. We're
Still got to add it back.
Add it back. But the reason we do the dance is because we do want it's a check figure to be sure that our M1 ties back to the tax return. Another variation I've seen, this has been primarily in ag lending, where ag lenders typically list all the revenue, specific expenses. They do it in detail so they can easily compare 1 year to the next. And I've seen them actually replace the depreciation from the tax return with a use cost or a calculated depreciation based on some percentage of the equipment in play, maybe a percentage of the real property. So they're actually replacing it. Now, software still adds it back for cash flow, but now their earnings figure looks a little more, it's even better than GAAP because it really is based on the kind of farming they do and the kind of equipment they have. So there's another variation that is really helpful. The third one, I think, is where there's a lot of confusion. So if you never use Section 179 depreciation, you don't even know what it is and you're not worried about it, sure, listen up for, comedy value, but it's not a problem. But if you ever have used Section 179 or somebody's told you to use it in a pass-through situation, listen up. Listen up. Section 179 is that first year depreciation. And it came about, I was doing practice when it came about. We had a bad year and they allowed, in a way to help the businesses, they gave them a first year write-off for $18,000, David. Woo! Wow. Right? I know it was so big. It's now up to millions. They've never taken it back, by the way. So when things get better, they never go back to, okay, never mind. They just keep making it bigger when we have disruptions and issues. So that was the reason for it, was to stimulate business purchase of equipment and buildings and such. It is a first year write-off though. So it's very possible that a small business can write off everything that they bought that year. And it's all gone. Well, there are some limits to Section 179. And so this is where it gets tricky. With Section 179, those limits are not at the entity level. There's limits to Section 179 that happen at the 1040 level. which means the section 179 has to come through by itself through the K and the K1. It lands on the back of 1040 Schedule E. It doesn't land on the front page depreciation of that 1065 or that 1120S. What do you do about that? Well, frankly, since we're going to add back whatever depreciation we use, I'm a real fan of not complicating things when it will not improve your analysis. I don't believe that throwing section 179, finding it on the K and then putting it where it belongs and then having your software take it back out. I don't think that's going to improve your understanding of this business at all, because section 179 is not GAAP depreciation. It just isn't. It's just a number we came up with, a way for people to write off depreciation more quickly. So what I do recommend and what we teach in our training is front page of a 1065 1120S, just use the depreciation that's there. Put it on the depreciation line in a place that your software or worksheet will find it and add it back. Don't also go after the section 179 and where is it and where does it pass through and what should I do with it. That does mean that on the back of 1040 Schedule E, where they list the partnership and S Corp, there's a column for section 179 because it has to come through, remember, by itself. So the tax preparer can apply the limit correctly. Ignore it. Ignore it. It doesn't improve your understanding of the business. It doesn't actually change your bottom line cash flow calculations. So that is a variation. I've seen people really want to use it, and I'm feeling like it doesn't improve your decision making and gives you another chance to make a mistake. Right? Let's not complicate things when it doesn't help our answer. So easiest, ignore it on the K, ignore it on the 1040 Schedule E, and just when you're doing an entity, add back depreciation from page 1. If you're doing personal analysis, ignore the section 179 column. Now, I have seen people use it anyway. I just don't recommend it. It doesn't help. So if I had a chance to actually make your guidelines, which I don't, not my department, I'm not going to do it. I'm never going to try to talk your folks who are in our program out of your guidelines ever. I will sometimes, though, when somebody says, here's our guidelines, I will sometimes say, with that guideline, here's something you might want to watch for. Right? Here's something you might be missing. Here's a risk you run if you always use K-1, no matter percentage ownership, for example. So we will point that out because we want them to spot compensating factors, anomalies, red flags, but we will never disagree with your guidelines. It's not our place to do it. But so I'm just going to disagree right now with you here. Section, if you're the one setting the guidelines and you got some complicated thing going on with section 179, reconsider if that is actually helping you. So to wrap it up, do add back depreciation, amortization, depletion that is included in the bottom line number that you put in your cash flow in the first place. Or if you are entering individual expenses, make sure that those 3 things go in a place that your software or worksheet can find and add it back. In the 1040 course on Lenders Online Training, we cover depreciation, all those non-cash items, depreciation, amortization, depletion in one of our modules. And then when you get into the advanced tax return courses, each of our case studies for the final includes a 1040 analysis with a partnership and an S Corp doing a global. So you actually do get the experience of practicing what do I count and what do I not count and how do I treat these things so that they get to the place they need to go. And you cannot gain the certificate from Lenders Online Training for tax return analysis until you have passed muster with David or me or Joe or Robert, the senior credit trainers, who will be on the virtual training with you, walking you, double checking how you're doing with the case study, getting you unstuck, answering questions, helping you apply your own guidelines to that. So that's it for today. Reach out to lendersonlinetraining.com to check it out. lendersonlinetraining.com/talk is how you get in touch with us to talk through, is this a good fit for me or my team? And experts at lendersonlinetraining.com is where you send us your question, we answer it, and who knows, it might become the fodder for one of our very fun live streams. Thank you very much, everybody. See you next time.